Imagine a future where the economy flips upside down. Are you prepared? In today's video, we're diving deep into the astonishing predictions of Michael Burry. If you're ready to challenge your understanding of the financial world, hit the like button, subscribe to our channel, and let's embark on this eye-opening journey together. In this video, we delve into the fascinating world of economic forecasting through the insights of Michael Burry, an enigmatic figure in the financial world known for his bold economic predictions. Known as the Movie Man, Burry has repeatedly demonstrated his willingness to risk his reputation, with predictions many consider daring. Let's reflect on 2006 and 2007, years in which Burry was ridiculed for predicting the collapse of the U.S. housing market. These forecasts proved incredibly accurate in 2008, demonstrating a remarkable insight into market trends, a skill that many had not recognized. In February 2021, Burry made another surprising prediction: a massive spike in inflation in the United States at a time when the last reported inflation rate was below 2%. Today, with layoffs hitting the tech sector, we can see how his words are confirmed, highlighting once again his ability to anticipate economic trends. Recently, Burry made another big prediction, suggesting an economic paradigm shift. He talked about an inflation peak, followed by a possible recession in the United States. In his view, this will not be the last peak of the cycle. He predicts a lower CPI, perhaps even negative, in the second half of 2023, with the United States entering a phase of recession, regardless of the definition adopted. Are you finding these insights into Burry's predictions thought-provoking? If so, don't forget to hit like and share this video with friends who enjoy deep financial discussions. Your support helps us bring more content like this to you. According to Burry, the Federal Reserve will be forced to cut rates, and the government will have to stimulate the economy, leading to another significant spike in inflation. The confidence with which Burry makes these predictions has always surprised many. He considers the current downward trend in inflation as just the beginning of a prolonged period of economic instability. The current situation recalls the 1970s, a decade characterized by cycles of inflation and fluctuating monetary policies. Charlie Munger, another world-renowned investor, is on the same wavelength as Burry, expressing doubts about the Fed's ability to maintain a strict monetary policy in the long term. Despite Burry and Munger's predictions, the Federal Reserve has expressed a different view. In a recent press conference, they clarified their intention to avoid past mistakes, recognizing the inflationary cycles of the 1970s and committing not to repeat the same errors. But while the Federal Reserve speaks of commitment and determination, Burry and Munger remain skeptical. Now we are facing a critical juncture in the economy. The question on everyone's mind is, will the Federal Reserve have the courage to fight inflation in the long term? Or will it yield to political and social pressure, as Burry and Munger fear? Their vision suggests an economic future in which inflation and recession may play a game of rebound, with significant impacts on people's lives and the global economy. But let's take a closer look at the situation. The current trend of layoffs in the technology sector is only a symptom of a broader issue. Inflation, often described as a lagging indicator, is beginning to manifest in different ways, not only through rising prices, but also through reduced consumer spending and impact on the job market. Then there is the factor of the Federal Reserve, an institution tasked with balancing economic growth with price stability. History has taught us that balancing these two objectives is delicate. The 1970s are a clear example of how reactive policies can lead to prolonged cycles of instability. Many wonder if today's Fed has learned from the past lessons or if it will find itself trapped in the same cycles. Burry and Munger are not the only ones expressing concerns. Other economists and market experts have started to raise similar questions, wondering if the Fed will be able to withstand political and social pressure to lower interest rates. There's also the issue of public and private debt. Higher interest rates increase the cost of debt, which can have ripple effects on the economy. In all this, we must also consider the global impact. The United States is not an economic island. Its policies and trends have repercussions worldwide. Developing countries and emerging markets are particularly vulnerable to these changes, as they heavily depend on the global economy for growth and development. We must also think about the role of other global central banks and their reactions to Fed policies. In an increasingly interconnected world, decisions by a major economy like the US can have domino effects on a global scale. This poses complex questions about managing inflation, debt, and growth in a global context. Moreover, there are growing concerns about economic inequality. Prolonged periods of inflation and recession tend to hit those already in vulnerable positions hardest. Rising prices, job instability, and limited access to credit create a toxic cocktail that can exacerbate existing inequalities. This is not just an economic issue, but also a social and political problem that requires attention. And that, dear viewers, is where we abruptly end today's journey into the world of economic forecasts. Just like the unpredictable markets, we leave you with thoughts to ponder. Stay sharp, question the norm, and until our next unexpected adventure, goodbye!